On Tuesday, February 13th, the headline screamed, Dow tumbles 500 points, post worst day since March of 2023 after hot inflation report. Well, during the day, the Dow was down 741 points, but by February 16th, the Dow had made back all but 82 points to where it had started only 4 days earlier on the 13th. So what happened? Is inflation hot or not? What's a business owner, entrepreneur like us to do? Well, we're going to tell you what's really going on and offer some answers you can take action on today.
Welcome to the Get Business Savvy podcast. I'm George Black, and this is AJ Bishop.
George, why would the market react so strongly to this report and then just a few days later be back to basically the same level?
Let me tell you something. You can't look at the markets and draw conclusions, because if you did, here's what you would conclude. Well, inflation was hot on February 13th, and by February 16th, everything's okay. It's like, no, it's not. You see, the dirty little secret is, and I did some digging on this, inflation has been increasing since July.
But George, hasn't the point of the interest rate hikes been to decrease inflation?
Right. And isn't that what we've been told? Inflation's coming down. They've got a target, 2%, all this kind of stuff. So here's what the markets reacted to. Let's start there first. And guys, I know some basic economics. I'm not an economist, but I know what I'm reading, okay? And I can translate that for you. So this is going to help you lead your companies in 2024. I'm going to show you how in just a minute. So what the markets were responding to was this. Back in December, the CPI, the Consumer Price Index, was no longer indicating a slowdown. So in December, it picked up 0.23%, and in January, it picked up 0.3%. Well, the markets are very superficial. They just catch data and they just freak out, and they think it's all of a sudden. Well, it's not. And this really surprised me. If I go to Fred, and Fred is the Federal Reserve Board of St. Louis, okay? And they put out all of this data. And I've got the charts and looked at them, and the core inflation rate has been increasing since last summer, July specifically. But the real indicator to look at is median CPI, Consumer Price Index. And I've got a link to it in the description, or if you're on YouTube, we're putting the graph up so you can see it. And looking at a percentage change over last year, it hit a low in July, okay? And then it's been trending up ever since. Now, it hit a range, and then in January, it broke out of the range and up dramatically. Now, here's what I didn't even know. In fact, I've never even heard anyone talk about this measure, but the Fed itself describes this measure, the core CPI measure, is a better measure of underlying inflation trends. In other words, by looking at this median CPI, we can see the inflation trends. The market's reacting to some report, but there's a deeper thing going on. We have to run our businesses that way. So the bottom line is this: the inflation data tracked by the Fed in the link below, okay, I'm just emphasizing this, reveals the economy is not headed to 2% inflation, and it's going the exact opposite direction. This completely disagrees with the conventional wisdom we're being told by both Wall Street and the Fed. Well, inflation, it's decreasing, and, we have some little bumps, but no, guys, there is nothing to suggest in these trends and graphs that inflation is coming down.
George, naturally, I have a lot of why questions here, but as your book says, why questions usually don't lead to satisfactory answers. So let's focus on what your book says. What path now? So given this fact that inflation's here to stay, no matter what they say, what can we do for our businesses to help us operate in this environment?
Right. Yeah. So that's my book, The Next Level Entrepreneur. It's a great question to use in these kinds of situations. What path now? Because that's what we're really interested in. In other words, the facts are the facts. By the way, let me just do one technical thing here. We're not saying, and the Fed isn't either, inflation is going to go away. What the Fed is saying, the rate of inflation is decreasing. Okay. So we're just simply looking at whether the rate of inflation is increasing or decreasing. I think the path now for us is understanding your numbers in your business. And let's take a minute and talk about, so in this hot inflation economy, and I do believe we do have a hot inflation economy, and I believe it's only going to keep going up, okay, until we see reversals in the trends. What I would suggest is watch your gross profit like a hawk and compare it historically. And if you've got enough history, the last 5 years would be great, because that would get you out pre-COVID, get a year pre-COVID like 2019, and then you've got COVID, which that may mess up numbers, and then on the other side of COVID, so you've got a couple of more years there. That's what I would suggest.
So we have this ongoing thing here, George, where I usually give a very textbook definition of a business term, and you have a much more practical definition. So I'm wondering, before I confuse people, how would you define gross profit?
Right. So I like to keep it simple. All right. And so first of all, look at your revenue line, and if you've got multiple revenue streams, then you kind of almost want to view this by those revenue streams. And it's simply all the direct expenses that tie to generating that revenue, with a couple of little caveats. So like manufacturing's, let me start there because that's an easier example. So in other words, if you're in a manufacturing business, your direct labor cost and your direct materials costs that go to making that widget and selling it at a price. So what are those costs? So that's what you would focus on. If you're in a service business, it would be the direct labor. So you might have people that produce that direct labor and produce the revenue with that direct labor. Now you'll have other people in your company like admin staff or sales staff and that sort of thing. Well, those don't apply. Okay. So we're just talking about to deliver the service or make the product. And so other labor, sales costs, all that kind of stuff, that's in the category called expenses.
Yeah, simple enough. It's the revenue you make minus all the expenses that went into making that product or service.
Right. And so there's two things you want to look at, guys. You want to look at the dollars, okay? And then you also want to look at the percent. So it's called gross profit dollars or gross profit. A lot of times people just think it's a percent, but you have to look at both. And so, and the percentage is like, how much did you make after it? So if you sold it for $100 and it cost you $60 to make the product or deliver the service, you had $40 left over, that would be a 40% gross profit. And for most companies, like most product sales, you're probably looking at a range of 25 to 45%. And that's going to mean that your costs are somewhere in the neighborhood of 75% to 60%. Well, in your business, that's most of your costs, okay? And then everything else is going to be down in that expense thing. So if we can get a handle on what those costs are, what we're paying, there's going to be, that's most of the expenses we're looking at. And right now for this exercise, all I want you to do is we want to go for the big stuff.
And what sort of time frame are you suggesting for looking at this data? Is it just a month, or do you need to look back a couple years, or since the beginning of your business? When would you suggest to look at this to compare?
Right. So it depends, obviously, how long your business has been in place, but you want to look at a reasonable range of data that's comparative. Okay. So in other words, if your business has changed significantly, say from 3 years ago to today, it may not be comparative. All right. So you're going to know that. But ideally, like I said at the beginning, I think you should look at 5 years. Now, I would look at it on an annual basis. So I would compare year over year, as many years back as you can, up to about 5 years. 3 years. See, the problem in this current environment is 3 years takes you back kind of into the middle of COVID. And for some people, that was really good. And for others, it was really bad. And you're just going to have to sort of make an adjustment there.
Yeah. And it was all based on unique circumstances. How did it impact your business?
Right. So, but what you're looking at to compare is those gross profit dollars and that percentage. And what you want to know is, how's my gross profit today, okay, compared to 5 years ago or 3 years ago? And so dollars are important, but you could pull your gross profit percent for January and February and then compare that percent to 3 years ago, because percentages are comparable. The dollars, well, you've only got 2 months of dollars, okay? You could actually take those dollars and multiply them out for a year's worth and say, okay, if I continue operating at this rate, here's how much I would generate in gross profit dollars for the year. Here's what we're trying to conclude. Am I doing better today, or say at the end of 2023, than I did 3 years ago or 5 years ago? Or am I doing worse?
So, George, if you're going back 5 years like you suggest, do you want to use like an inflation calculator or anything to, like, norm things out? Because, you're comparing from 2019, and we know inflation's been going on from 2019 to 2024. It's always going on.
Absolutely. This is where we were headed. Good catch. Because now that you've got comparative data, you've got your data, you've got your gross profit numbers. Now with the dollars, let's find out what they're worth today. Okay. So if you take your 2019 gross profit dollars, I can tell you with an inflation calculator, they are worth 20.6% more than the dollars in 2024. That's how much inflation's gone up in 5 years. Okay. So now take that gross profit dollars and compare and go, now is my 2024 numbers higher than my inflation adjusted 2019 numbers? Okay. So guys, what I've done is I've put an inflation calculator in the link. It's my favorite to use. And you can put in whatever year you want and whatever dollar amount you want, and it'll calculate it to whatever year you want. Okay. So it's got like good variables, and it's eye-opening.
Does the calculator project forward, or can you put an assumption in there for a forward inflation rate?
No, it can only tell you what happened.
Okay.
It's not a predictor, but it will tell you this. So let me give an example. So let's say you had $10,000 of gross profit in 2019. Okay. So that's now worth 20% more. All right. So it's worth $12,000 in today's dollars. Well, if you only made $11,000 of gross profit in 2024, or say into 2023, you made $1,000 less, but it doesn't feel like it. It feels like you made more money, but in reality, you actually made more money in 2019 because you had more buying power with that $10,000. I hope that makes sense. I know this is wonky. It's a little tricky, but if you can get your head around this, it'll really help.
Yeah, and it's good that you put it that way, that buying power is the most important thing. It's not just the nominal dollar amount, because that dollar has a value that's fluctuating. It's really what can you get with that dollar. The example I'm always thinking about is the $5 footlong. When I was a kid, you used to be able to get a footlong sandwich from Subway for $5. And now I go online to order it, and it's $9.39 for a footlong, and you can't even get a 6-inch for $5. The 6-inch is $6.50.
That's a great example, AJ, because I think it illustrates a couple of things. First of all, everybody can remember the $5 footlong. Now they're selling them for $9.39, and the marketing on that was fantastic. You can't really market $9.39, and they probably won't, because it's probably going to be $10.39 next week. So what does it mean if I put it in the inflation calculator? Well, if I do that, and let's use 2011 as sort of a mid-range on the years that was being offered, it would be $6.86, basically about the same price as the 6-inch. So we lost a whole 6 inches in all those years. So here's the other thing, is that there's probably other costs that went up at a higher rate of inflation. And we know the restaurant industry has been hit harder because of food costs and specific labor costs, particularly in the last few years. So when you're using the inflation calculator, keep that in mind. Keep in mind what it is you're doing and what you're selling or making and the specifics. Because if you've had, and you can do deep dives into this detail and find out what a specific kind of labor rate's done, what have specific kinds of product or material costs have done. But I don't think you need to get too wonky about it. But the thing is that you want to be beating the rate of inflation.
And yeah, that makes a lot of sense. You want a price to stay ahead of the rate of inflation. And especially because you don't want to be raising your price on your customers every month. You don't want them to walk in and it be the $5 foot long and then the $5.50 foot long the next week and then the $6 foot long the week after that. When in reality, if you can kind of predict, okay, this year inflation's going to be here, you could set your price to that level. And then throughout the year, you can just keep it stable. And so people then, maybe they'll be a little shocked at the first price increase, but by mid-year, they'll hear all these inflation reports and be like, wow, AJ still kept his prices the same. And you can win the goodwill that type of way. So being proactive also helps you avoid that downside of customers feeling the pressure.
Yeah, that is a great point. And here's the thing, and here's the whole point of the podcast is if you're thinking the Fed's going to end up at a 2% inflation rate, and it's instead going the other way and could be 5% or 6%, well, that changes everything. I mean, guys, that's like half your profit margin in the bottom line. So here's what I want you to know is look at these charts, study them, and see how it applies to your business and get ahead of this curve. Study your numbers, the gross profit numbers, look at them from an inflation standpoint using the calculator, and then figure out like, hey, if we've got to do some inflation adjusting pricing, go ahead and do it now and adjust for higher inflation coming. So you're like AJ, and if prices do increase and they're going to continue increasing, you can, you're sitting there and you haven't changed your price. So try that. And, but I know everybody's situation's a little different. I want you to know we're starting to offer masterminds, maximum 12 people in a group, to help you with your specific issues in business. That what we're after is helping you build continual growth that's got great profitability. And to give you some feel for that, we've got these free webinars. Go to getbusinesssavvy.com or just click the link below. And you can come to a webinar. We'll also have a link to the masterminds. You can check them out for more details. And I would really encourage you to watch last week's video. I know you're going to love it. And until next time, may you live truly free.